Waking up to this news of an invasion, what do you tell worried investors?
Yeah, I think, this isn't terribly surprising. We've been knowing that it was a likely scenario. But I will say, we spent time looking at all the other geopolitical events since 1940 and look at the reaction of the S&P 500 over time. And within 1 month, the S&P 500 has been positive 66% of the time. And looking out 1 year, it's positive more than 80% of the time. So I think even though these events are troubling, they typically have presented a buying opportunity unless the impact is so great that it really does have a meaningful impact on our economy and a meaningful impact on corporate earnings. And so far, we're not seeing that. We think it's an unlikely scenario. So we would take this opportunity to, add to high quality names within your allocation and stay diversified.
Hey, Brenda, let's just ask that unless question. Is this different this time? I guess part of, if you wanted to point to that to make that case, you could say, look at what's happening to commodities prices. If you look at energy, if you look at the grains, if you look at hard metals prices, all of them up really significantly. And that's on top of the gains we've already seen. Inflation being at such incredibly high levels around the globe at this point. That adds to the picture and puts additional pressure on central banks to go ahead and raise rates more quickly to try and fight that. What do you think happens in that scenario? And if they did raise rates, would it bring on recession?
Yeah, I think rates are still, they're still at zero. So we have a ways to go. And if we look at the health of the consumer, the consumer outlays to service debt payments are at 40-year lows. Wage growth is high. Despite consumer sentiment, there are several readings suggesting that there is actually real wage growth happening. So in excess of inflation right now for many people. So I think the consumer still has some wiggle room. That being said, I think if there was a massive dislocation within the energy market, that there would likely need to be some government intervention to help support, continued drilling activity in our own country, which your previous guest kind of alluded to. But there have been huge disincentives to go that way. But certainly high oil prices make it much more financially attractive. So I think but overall, we think it should be manageable at this point. But fair to say that, only time will really tell.
Katie, let's talk about what we've seen with major averages. All three of the major averages touched below their intraday lows from January 24th yesterday. You actually had both the NASDAQ and the Dow closing below those levels. And then you see this additional pressure this morning to the tune of several percentage points. What does this mean technically?
I mean, it's essentially a short-term breakdown below those January lows, but those are very minor support levels. And what we often see is when you get this kind of big downdraft, it really shakes out market sentiment. Sentiment was already getting pretty bearish. And a day like today, where you see all sorts of gaps down from a bottom-up perspective, that really can shake out the market. So we wouldn't be buying today necessarily, but it does suggest that there's an increased chance that these breakdowns that we'll likely see are actually shakeouts or false breakdowns, and it ends up being a pretty good buying opportunity.
Shepard Smith here. Thanks for watching CNBC on YouTube.